Good evening to all of you. Welcome you to today's webinar. Today our discussion will be on option strategies. Then also we'll look at the margin, and also we'll introduce you to probably what we call as a rollover. And also we will discuss this in the second part on Monday. Now we have already discussed option strategies many times before, but again in order to recap the discussion, because right now the market is in a different mode compared to what it was before. So we need to understand the market from the strategies in the present context. Now what is happening right now is that we have a very low volatility in the market. A low volatility in the sense that probably the IV is in the range of say 12-13% approximately, but prices steeply climbing, which we have not seen at all before. The strength of the rally, I think the prices are climbing too steeply, and almost all sectors are participating except auto, right? So this is the characteristic of the market right now. So a low volatility scenario, prices are climbing steeply, but that also gives you a fear that probably if something goes a little bit wrong because of the huge valuation, very high valuation as per the fundamental reports, probably if there is some disappointment or some problem comes, then probably the fall can also be steep. We don't expect that, but we have to be prepared for it, right? So as an investor, as well as a trader, we always need to be prepared because we cannot take anything for granted. That is the reason why we always look for the option as a strategy to participate in the market. Now option, it comes in the F&O segment. So to that extent, we have to be careful, because in F&O, if you do it only in futures, you need a higher cash outflow in terms of margin, right? So futures margin is much higher, and that's why we have been recommending that look option as an alternative asset to futures trading. So the way you are going to trade the futures, the same way you are going to trade the option. We have said that in case if you feel the market is on up, you want to express your opinion on the upside, then you go long in the market in futures. Similarly, you go long in the call option. So you go long call, right? So now that is the case. So it's a bull market. So we will concentrate on a bull market. It's a long call or probably short put, right? Short put. This is one. Then third is of course the call spread. Buy call spread, okay, or you have sell put spread, right? So these are, or you do a caller option where you are buying call, selling put, right? So you are doing these strategies. So all these things will depend basically on the margin that you have, the amount of funds that you are willing to put in, the risk that you are willing to take. So most important thing in any of this trading aspect is that the investment, the risk factor, okay, these are the very important thing that you need to look at it, right? So when compared to futures, in terms of investment, option scores, right? Option scores. Same thing in terms of risk management, option scores, because the amount of loss that you are going to have is only the premium amount that you have paid. So in the event of something going abnormally wrong for some reason, the maximum limit, risk that you are going to take is only on the option premium. So now that being understood, what is very important is that is there only advantages in option? What is the disadvantage of an option? How to overcome that, right? Because the reason is, suppose now the option price is say for a week, the Nifty at the money call, say last week it was around, say Thursday it was around 17,600 or so, right? That is day before yesterday. So that time during the close time it was 17,620, 630 levels. That time if you look at it, the average the option price is approximately say 100 rupees for at the money. If it is 17,600, the price is approximately 100 rupees or so. Okay. it could be 110 or whatever it is, but I'm just giving as an illustration. So it is only 100 rupees. Now, may look at it. See, this is the one easiest way of doing is. See, since the market is climbing quite fast, okay. So today the market went up to 17,800. So only if you had bought a futures, you would have gained 200 rupees. Since yesterday, today when the market hit 17,800, you would have got 200 rupees, right? In the case of an option, since you paid 17,600, you paid 100 rupees as a premium. So the 17,800 when it went, that 100 rupees could have become something like 230 rupees or so. So 130 rupees is what probably you would have got, okay, as a profit. So if you want to really have the same profit like a futures by the expiry time, you should have had 2 quantity of call option instead of 1 futures if you are buying at the money, okay, generally speaking. Now that means you will pay 100 plus 100, 200 rupees, or 100 into 50, 5,000, and 2 units of it is 10,000. So where is 10,000 and where is a lakh and not? So definitely the option as an investment scores. But the entire problem that is going to come is that if the market is also below 17,500, if you are doing only one option, or if the market is below 17,400, right? So normally it will not be generally, okay, let's say to 17,400. Then you got bought 2 units, so the maximum loss is 200. But whereas in the case of a futures, if it drops below this mark, then you will have much greater loss. So to that extent, the risk mitigation is also better in case of a option compared to the futures. But the problem comes is that what happens if it is just stagnates anything between 17,500 to 17,700. So in this case, if the futures comes down to 17,500, you will lose only 100 rupees in futures, but whereas you would have lost 200 rupees in the case of an option, because you bought 2 units. Similarly, at 17,700, in the case of a futures, you would have made 100 rupees, but whereas in the case of an option, you would not have lost anything, you would not have gained also. So you need definitely something above the 100 rupees mark for you to start gaining in the option, and the greater the rally, probably you will get a good profit. So one way of looking at it is that over a period of time, okay, over a period of time, probably sometimes it stagnates, sometimes it rallies more than this, so probably you will be able to even out. That's what you may be thinking. But right now the market is like that. So in the present context, probably what our thought process that let's buy 2 units, maximum risk is 200, so it doesn't matter. So we will just ride on that and make good amount of profit. Now when you but the moment it stagnates exactly, suppose a lot of times there is a chance that if before you take profit, like today, you may be thinking the market is still going up, so probably it goes up and then comes down to the same level of 17,600, and let us say it closes next week only at 17,600, 600 or 630. Let us say it closes like that. Then what happens is the entire time value of 100 rupees which you paid will be lost. Not only 100 rupees, probably you will lose 200 rupees because you bought 2 units. Okay. So this is the problem. This is the only problem that in the case of an option that you face, and there can be some circumstances where it can be very frustrating to hold it. So you must devise strategies which can probably take into account all these things. So that is where your pure calculation comes. One is, very well the market is on the upside, to what extent the market can dip, and then to what extent it can rally within a week or within a month. So these are thought process that you need to have. So that one is that the past experience which shows you, then the present technical analysis which gives you some indication of where the support comes. So these things can help you to decide the type of strategy that you would like to do, and the type of profit that you would like to have. Okay, whether you would like to have limited profit, risk managed, lower margin, or you would like to have good amount of profit, but you don't mind taking the risk of an option premium decay. So this is exactly where the judgment or where the application of a trader comes. So this cannot be really told every time that you do like this, because it is everybody's judgment and we do not know what is going to happen at the expiry period. So what is it that we want is very important while designing any particular option strategy. So let us say that we don't want to have any amount of time decay. Let us say you don't want to have any amount of time decay in this, and also you know that very well that probably if the Nifty rallies, generally speaking, the rally could be on a week-to-week basis, can be close on a close basis. It could be 200 points. It could be 200 points. Maximum it could be 300 to 400 points, right? So let us say 300 points could be an average gain, because rallying every time above 300 points is not that easy on a week-to-week basis. So we will also look at the chart for a minute and then come to a conclusion on that. So let's look at the weekly chart. Okay, now let's say this particular week it was 17,323, and the week before was 16,705. This is a 600 points gain. So this is a very abnormal movement. 600 points, normally it's very difficult for it to keep rallying like that. Now after this, if you see, after a big rally, okay, now you see this place 17,323 here, and this week it was 17,369. So not much of a gain. Now 17,369, we do not know what's going to happen, but probably let us say it settles down around 600 or 700. It's around 300 points is what probably you will have. And you will go to the weeks before. So this week 16,529. Here it was 16,238. So it's almost I would say something like 300 points. The week before it was 15,763 and 16,238. So that has been a 500 points rally has been there. So now the situation comes here is that sometimes the rally could be even 500, 600 points. Okay, so if you do any type of spread strategy, okay, it may not work properly. It may not work properly. So the alternate thing that you can do is, now you don't want to lose less amount of money, but you would like to look at something like out of the money call option. Let us say out of the money call option. Since there will be circumstances when you get a 300, 400, 500, 600 points of rally. So let's say you are looking at some 200 points away from this, then probably you will be paying only 20, 30 rupees, right? So you will be paying only 20 to 30 rupees, maybe as an option premium, because 100 rupees means the next will be something like it could be 50, and then probably it could be 30 or so, or whatever it is. So maybe 30, 35 rupees is where maximum you will be paying for something like a 200 rupees away from the strike. So you pay 30 rupees and the maximum loss is going to be 1,500 rupees, right? So out of the money option by 200 points over a period of time, whether that is going to make money or not, probably it could be even better than at the money call, because the maximum loss is going to be that much. But if there is a rally, then probably there could be a significant gain. So even statistically, when we have seen this, that generally speaking, an out of the money call option, which is almost equal to double the option premium, okay, definitely as a works, it works. So either you go for some 150 points thing. 150 points means you will pay, if it is 17,600, you buy 17,150 by this week, probably you will have some, it could be something like 50 rupees or so. So generally speaking, though, that is an acceptable thing, and so you buy something which is 150 rupees away and just pay 50 rupees and leave the trade, because the maximum loss, if it slides down compared to the futures, is going to be 50 rupees. But if the rally is going to take place, probably the gains could be still there for the investment that you make. So that is one way of looking at it. Okay, the second way of looking at it is that since the market is going up very significantly, and for very sure that you don't want to lose anything on the time decay, but you would like something to behave like a futures, because the best thing that in a bull market could be is to hold on the cash market or the futures, right? So you would like to have something which behaves like a futures, okay, because you know very well that the market is going the upside, so the maximum loss should be restricted only to the option premium that you're going to pay. So in that particular case, to choose an option strike which is slightly deep in the money. Okay, now if the market is 17,600 or so, so let's look at, you are looking at something like 17,300 or so or option, or 17,400 option. Now let us say today it is closed at 17,585 or 600. Okay, so let us look at what the option price is for 17,000. Now 17,600 is going approximately at 100 rupees. That's what I told you. Now if you look at the 17,400, it is 36 rupees. Sorry, 17,400 is 240 rupees, and 17,300 is 328 rupees. So that means the market is pricing something like 17,328. It is asking you to pay a little bit on the option time decay, which is approximately 23 rupees for 17,300. And I'm for a week or so to pay on 23 rupees or so is something slightly on the abnormal side, because 17,300 plus 328, 17,628. But whereas the market is only at 17,000, the cash market is 17,585 or so. So 585 or so. So I think probably it is quite steep for us to pay. Now let us look at the futures price. In this case, Nifty futures price. So Nifty futures. So 30th September, the last price is trading at 17,605. Last price is trading at 17,605, which is only 20 rupees from 17,585. It's only 20 rupees. But when we see the 17,300, then we are being forced to pay something like 17,623 or so. So this means very clearly that you need to be careful about that particular time of option payment, because there will be some circumstances where probably you may end up paying much more than the option this one. So if the amount is 17,605 for futures, then paying another 18 rupees per a week, because it's 17,605, 18 rupees per week additional when compared to the futures, is works out something like a 0.1% or so, right? 0.1%. So in a month it was to 0.4%, and on a yearly terms it looks another 4.5% or so, which should be avoided, because that is where you have to decide about the amount of time decay that you are willing, because you want something to function like a futures, okay, something like a futures, okay, and because you want to reduce the margin, but you want a result which is something very closer to the futures. So in that case, whether you would like to pay 23 rupees for it, not only 23 rupees, you have to pay something like a 40 rupees or 50 rupees as a time decay. In that particular case, in order to avoid that, you have to think about whether you want to go for a spread or you want to go for a slightly even more deep in the money. Now here we look at the option chain. So if we go for a 17,100, then we get something 17,100 also. Then we pay 520, which is 17,620, 17,620, and here 17,300 is also 17,625. So I think there is something wrong in this calculation. It cannot be something like this. So there is something abnormality as far as the option closing prices are concerned. 17,300 is also coming to 17,628 and 17,200, because the time decay is what we are looking at it, and 17,200 also is coming very closer to that. That means we are not having that much of a difference in those cases, right? So we need to be careful about the quotes then, because the reason is that we don't want to spend too much on the time decay. So what should have happened in this particular case? Now when it's saying 17,200 is only 17 rupees and the present market is going at 17,600 or so. So this should have been much lower. This should have been something like 400, 410, something like that. It cannot be another 7 rupees or 8 rupees there extra there. So there is something which we have to look at it, whether we are going to pay that much for a time decay, the extra amount that you are going to pay. So we have to look at all these things and then take a call whether what is it that we are going to do. Now the other thing is that since the market started at 17,600 or so, and generally speaking we will not get, let us say 17,900 or 18,000, then in that case we need to go for a spread which could be 17,300. Then probably then we are looking at something like a 18,000 call spread difference. But then in that case you have to pay for the exposure margin. So what is it that you want? That is that will decide whether what type of an option strategy that you are going to look at it. So the general suggestion that will be is, now since the market is on the upward movement, don't spend too much on the time decay, but only go for something which is slightly deep in the money in order to reduce your investment. Assuming that you are going for a 17,300 call, you will be paying only 328 rupees. You will be paying 328 rupees. So which in the present circumstances, because of the huge rally that is taking place in the market of a significant percentage gain, probably you are accommodating a slightly higher interest cost, bearing cost in this particular case. So here you are looking at 17,300, you will be paying something like 328. Or let us look at for the entire month, that is for the entire September month or next month also. So let us say we are looking at 30th September. Now here also 17,300, it's going, it's a very abnormal price. If you see, 17,300 is going at 373 rupees. This is quite an abnormal volatility it is giving, because this is 63 rupees on this one. That is, it is a very abnormal thing that you are paying, going to pay 17,300 plus 371, 17,673, when you can buy the futures itself for 17,605. You cannot afford to pay such a huge amount of thing of 17,300. So you need to look at what exactly for the 2 weeks together what you are going to pay. Probably you can look at something like 17,640 levels. 640 levels, that comes to 17,640. Present circumstance 17,605. So for 2 weeks you are paying almost the same thing like this. So you can go for this, or you can look at the October contract also, because you have to decide now on the time decay that you are willing to give, because the market is definitely in the upside. And at the same time, you do not want too much of a time decay to take place. So what is it that probably you will be looking from the perspective of the carry on cost, because one is the futures itself is a carryover on the spot price. So as far as possible, our investment should be done very closer to the spot price. But in the case of a futures, if this is going to come, because the futures itself is going to reflect some percentage on the spot, then what is it that further that the option premium is going to reflect? So put together all the cost together with the carry cost of the futures plus carry cost of the option, I think the ideal thing should work out something like 6% per annum. Such a strike should be taken. Such a strike should be taken. But at the same time, the investment should be something like a 30,000 or 35,000 rupees maximum for the contract. So let's look at the next month also. It's a very for the full 1 month we are getting 17,710 or 715. I think it's quite still a very expensive proposition. So what I suggest is that you keep in mind all those things, because it's not something which we can ready-made tell you that this is what you should do. The only thing that we can say is, if the 17,300 and 17,000 by picking up 17,300 or 17,100 or 17,000 for this month, could result probably in a very low carry cost, then it is better to do. For example, the same thing in this in this week, 23rd September, let us say a 17,000 call. So this is coming very closer to the futures, 610 or so. So 17,610, and which means we don't have much of a carry cost compared to the futures. So that's coming. So that means you're paying 600 rupees into 50. So that means 30,000 rupees. So I suggest that probably this is not a risk mitigation type. But if you pay 17,000 option, okay, 17,000. Then in that case you are paying only for 17,610, which is quite closer to the futures price. So it's almost like buying the futures, right? It's almost like buying the futures. But futures you have to pay 1,10,000, but here you are paying only 30,000 rupees. You are going to pay only 30,000 rupees. Suppose if you want to make this even more attractive, then probably and if you feel that since the market was 17,600 or so, this 400 rupees is probably a little. It's not going to happen every week or so. And already we have got the general gains have been generally 400 rupees or so. Only in extraordinary weeks you have got 600 points. So if that be the case, then probably you can take an 18,000 this one. So if you sell this, then probably you are bringing this much equivalent or probably even lesser than the futures. And then so the carry cost is reduced. But probably you need to pay a little bit of the on the exposure margin. So for which probably you may have to pay another 15,000 rupees extra plus 30,000, so it will become 45,000. Still much worthwhile, but because you are buying it now lesser than the futures, okay, lesser than the futures and carrying it. So to that extent, you have to make an analysis of whether you want to reduce a cost which is below the futures, okay. At the same time, the gains are almost like a futures. Okay, gains are almost like a futures. Now, the second thing is that you can always think about is that okay, you want to keep rolling over some positions. Okay, so now let us say this particular option, let us say 17,600. So, what is the general feeling now? The market will have a strong support at 17,400, right? So 17,400 is likely to be a very strong support right now. So what you do is that you 17,400 you have at 240 rupees, right? 240 rupees. Then you have 17,831 rupees, 31 rupees. So if you do this, it's coming very similar to the futures. It is very similar to futures. So let us say the market advances, goes up from here. Then in that case, what you do is that you, of course, one or two times you shift, because you from 17,400, 17,800, you are doing a spread. Sometimes the market can be just below 17,800, so you don't need to do anything about it. But in case you get a rally now which is going to be above 17,800, let us say, then in that case what you do is you have a profit from 17,400 to 17,800. So that profit will be there. So you take the profits and probably shift it one time up, so that you are able to get some more profit. So now I hope I will be able to tell you this. See, it is like this. Now let us say you are doing 17,400 call you are buying and 17,800 call you are selling. Okay, so this will come closer to 200 rupees. Now let us say till 17,800, till it breaks 17,800, let's say you are keeping quiet, you are not doing anything. So it will become almost like a futures, okay, doing this point. And in this case, probably for 17,400 you are paying some 230 rupees or premium, plus 15,000 rupees exposure margin. So probably maybe 25k will be the investment here. Okay, maybe 25k is the investment here. So what you do is that the market goes up above 17,800. So you probably know that even if it goes up, it could be up to 18,000. So what you do is that one time the moment it crosses 17,800, you shift this option to 17,500 to 17,900. shift it by another 100 rupees, you will have a profit which is from 17,400, 17,000. When it crosses, you will have very decent profit for this. Then you shift it one time, okay, and then leave it there, Then in that case, no, you will have a profit which is something similar to futures, but slightly less than futures, because when you shift it, you will not have the same because from 17.6 to 17.8, when futures advances itself by 200 rupees, probably the profit in this case you may not get 200 rupees, you may get something like 70 rupees or under 80 rupees or so. So once it starts to rally above this, once you shift it and leave it, from there it will become like the fuel futures till such time the 17,900 is not crossed. So probably you will have end up maybe with a gain which is less than the futures. Okay, so that's the disadvantage. But the advantage is that if it goes below 17,400 at any cost, then probably the loss will be much reduced compared to the future. So that is one thing. So suppose if you have a strong feeling that in this market, let us not complicate anything. Okay, let us not complicate anything. Then in that case, what the easiest thing is, just buy a 17,000 option, which is coming at 610 rupees. It's only 5 rupees more than the futures buying for September end. Okay. So you are paying an option for next week, right? So what you are doing is that you have let us say 17,585 or 590 is where it has closed today. So approximately 20 rupees you are paying, so 0.1%. So the total cost that you are paying is around 4.8 to 5% on an annualized basis. Keep it like that, and you just pay 30,000 rupees. Then leave it there. So you are paying only 30,000 rupees, and you are getting something which is similar to the futures. So that is the best strategy in the present circumstances. But if it falls also, since 17,000 is quite below, it will also behave like a futures. Okay, it will behave like a futures, but with very low margin, And if it comes down, then I mean, like, you don't need to roll over such positions because it is already deep in the money. There's nothing you're going to gain by rolling over such positions. So in the present circumstances, you can just look at a 17,000 call, and then so 500, 600 rupees down the line, you keep rolling the week, then the subsequent week and other things, till such time probably you get a fall which is below 17,400. Below 17,400, when the market comes down, you hold yourself for some time, and then see to what extent the market drops down. Even if it drops down by 200, 300 points, from there if it looks like going up, it stabilizes and then starts going up, then you can again re-enter the position on the long side. So right now, this is the strategy. Other strategies, if you do, then probably you will have one is that if you do a call spread or you do a put spread. Let us say you are doing a call spread, buy call spread. If you are doing a buy call spread, buy call and sell call, okay, you will have limited profit. Similarly, you have the sell put, buy put on the lower side. This will definitely be profitable. Question is, you will still have a lower profit. So these things will have lower profit. Now if you buy out of the money option, then in that case, in these circumstances, if you go and buy above 150 points, okay, from the 17,600 was last week close, so 17,750 you buy, okay, then you will have to pay 50 rupees, and then that will come to 17,800. Not that every time the market can go above 17,800, and more or less that chances will be, because there are, if you see in the last few weeks also, 2-3 weeks it went up. There are many weeks that probably it may not even cross the 200 points. This time it is happening. So then in that case, you will not make much of a profit as far as that is also concerned. So a selling put spread, probably consistently over a period of time, selling a put spread consistently over a period of time will make money. Okay, will make money, like selling put spread, buying this one, or buy call of this particular strike and sell put call of this. If you do consistently over a period of time, you will make money. But in a deep bull run like this, then the easiest thing is to be an investment in the cash market or buying futures, or the alternate is to buy the deep in the money option. That is what we illustrated. And by doing this, you are reducing your margin requirement from 1,10,000 straight away to 30,000 rupees. So here what you have to do is, in a bull market like this, you have to concentrate on just rationalizing your investment rather than spending too much on risk management of the position. Okay. And if at all, if it falls for some reason in a very big manner, then you have got the 17,000 itself is the stop loss. Itself is the stop loss. The second probable aspect that probably you don't want to do that, then in that case, no, you don't mind paying this. Then in that case, you have to consider slightly higher amount of option units if you go for 17,300 or so, because you are paying some amount of time value. So in order to recover that particular time value or so you need to, instead of one option, you need to consider probably, very difficult to say 1.5, because 1.5 units you can't buy. So you may have to go for 2 units or so, 2 units or so. So the question here is that whether the any strategy right now must be to focus to derive the maximum amount of profit which a futures gives. So whatever strategy that you design as option should also mirror the profit in the futures, but reduce your margin money significantly. Third thing is, whatever loss that you may get in the futures is the loss probably but you will get in the option also in this particular case, because it's behaving like a futures, right? But suppose otherwise, if you do anything, the profit will be quite limited. So what is the risk of in a situation like this is what we have to decide. So only in cases where the market is having a fall, but probably you do not know, suddenly it can rise, those are the times when we have to consider some alternate strategy, right? And any other strategy where you buy a call and sell a put, marginal money will be like a futures. Okay, we want to avoid that. So right now this is the strategy. We look at a bank Nifty also for the time being. Now bank Nifty raised it to 38,000. So right now I think the market is quite hot as far as bank Nifty is concerned. So maximum dip we are seeing is around 1,000 points from the top to bottom. So we don't expect, like the fall to be much below 37,100 or so. So 37,100, because from where the market had some correction up to 36,200. So any dip towards 37,100 or even higher probably will get a strong support for bank Nifty. So bank Nifty is something which probably you can look at it more from the profit point even when compared to Nifty. Question there is that bank Nifty has already rallied so significantly, but today it had a dip of 500 points from the intraday peak, okay, of more than 38,000 to 37,500, which itself was an opportunity to go long, keeping 37,000 as a stop loss. Okay, keeping 37,000 as a stop loss. So the bank Nifty thing is that we'll look at bank Nifty option strike. Bank Nifty option chain. So bank Nifty spot close is 37,811. So this week, if you look at it, is so if you consider 37,000 call option, it is going at 928 rupees. So 928. So bank Nifty going by the same logic of a rally. So 37,000 call option is around 928. This is into 25. So it's less than 25,000 rupees, right? For which we are paying something like 928 is this. So 37,000 928 is what we are paying, okay, which is still comparatively I feel is slightly on the higher side, because 37,810 or so is the this one, but Nifty futures, Bank Nifty futures is quoting at a much higher price. It's quoting at a much higher price, so probably the return on Bank Nifty has to be much more than Nifty. So here, when you pay for this, is we are paying something like 100 rupees extra comparatively, right? So that is still coming out to be 0.3%. 0.3% for 0.25% for the week or so. So maybe 0.25% for the week, which is 1% for the month and 12% for the entire period. So this is a slightly expensive proposition still, but considering the present mood of the market, okay, so it is better to fund it through this rather than looking at the this one, because the futures itself is quite expensive. So let us say look at the futures here. Futures itself is going at 100 rupees or more. So let's look at the so here, let us say the last price is 37,910. 37,910. So the futures itself is going at such a heavy premium compared to Nifty. So here it is going at something like a 100 rupees difference, which itself is something like 0.25% approximately. So even for a single for the 30th September, it is going at that. So 0.25%. Is almost for 10 days or so. It's almost for 10 days or so, which itself seems to be around 9% per year or so. So still quite a very expensive proposition, and on the top of it, we had to pay the option premium. So there is no other alternative, considering the gains that normally the Bank Nifty rally. Probably as a percentage, the volatility is much more. So that's the difference. So, but whereas in the case of a futures Nifty, if you want to go for it, the very normal thing is that the futures should have something like 4% or so is the month-on-month futures rollover cost should be 4% or less, and I think we should keep the option premium position something like another 2% or so. So maximum we should give spot difference for all the trading is 6%, because even if the spot rallies by 10-12% in a year, we still get 6%, but the amount of money that we are investing is much lower, so which should give us some very decent gain, very decent return, very high return in fact for the investment that you are making in the option. So that is how we should consider. But right now the Bank Nifty also looking so strong that it is not worthwhile to consider alternative strategies where probably the profits could be limited, and so the best thing is to consider something like a deep in the money. And when I told you 925 rupees into 928, 25,000 rupees. But what is the amount of futures if you're going to pay? It's something like 1,60,000. It's going to be 1,60,000 if you're going to do a futures trade there. So comparatively, this is a very much easier trade. So you can look at round figures, which could be 37,500 or 37,000. All those things you can look at it. So it is much easier, and probably I wouldn't say it's very safe, because if you do a 37,000 Bank Nifty option, the loss in the futures or loss in the options is going to be the same. But what we are going to do is that we are reducing the investment amount, considering the market's gain is likely to be on the upside. That's all from the present perspective position. So this is how we consider. So now we have told about the rollover of options, where probably you can roll over your option contracts. We highlighted in the form of a spread contract, right? Now, if you look at the in order to reduce the time decay, the one thing is that if I told you about the call option, the call option size, the best thing is to just ensure that one way is to you can try it out, but there will be some decay, but anyway you can try it out. Now, this possibility that Nifty futures, let us say now it's 17,600, you're paying 100 rupees, right? So 17,600 call option you are buying at 100 rupees. Okay, you buy 2 units. Okay. Now tomorrow, let us say it goes to 17,700. Okay. What is the profit that you will make here? You will make 100 rupees into 2. Approximate, I am saying, time decay and all will also play its part. So I am just going by theoretical thing. So you will also make, since it went up by 100 rupees, you will also make approximately 100 rupees profit also. 100 rupees profit also you will make. Now what you do is that you shift the 17,600 call to 17,000, because the moment it starts to rally, the thing is 17,800, 900, probably the profit that you are going to get by holding this is going to be higher. But at the same time, you will have the risk of the time decay which also comes, right, in case if it falls back to 17,700. Okay. So instead of that, what you do is that you just roll over the position. 17,700, you have the profit. Okay. Now, assuming it comes back, okay, to 17,600, okay, from 700, again you roll it over back. Okay. So you just do this particular thing in this market. Probably, there is a chance, okay, good amount of chance, unless it's the last day or so. Okay. So what you do is that instead of taking the nearest month, okay, nearest week, where the option time decay will be very high, if you decide to roll over the option, consider something which is slightly distant one. For example, let us say you are doing an October month contract. So October month contract, let us say for this is going to be at, assuming that it is at 300 rupees or so. Let us say it's going to be 300 rupees or so, right? I'm just saying, assuming you are doing it something like a 300 rupees or so. Okay. 300 into probably 50 into 2. So this is going to keep reducing it. So 30,000 will finally come down to 10,000 by the week. But let us say you don't want to waste too much of a time decay, particularly in the last day or so when probably the market could get stuck. So probably just before the last day, so till 1 week before, you keep doing it a distant, you keep doing it, and the last week you ensure that you shift it to a slightly distant month period in order to get away from the time decay, particularly during the weekends that you may get. Okay. So now, say today itself, if we look at the figure, 17,600 or so yesterday, it was 100 rupees plus 17,600 put together was something like 210 rupees or so. Today it has become 190 or 200. I think, if you look at the option, this one, it has come down. Nifty option chain. See, today it has come to 198 or so. Yesterday it was something like 210. Because it has come down to 17,000, yesterday it was 17,630, slightly, so 17,585 or 600, to that extent some difference is there. But today if you have rolled over the position, it went up to 17,800 or so. So by the time you would have rolled over your position, okay. So rolled over the position, probably you would have taken profit. You would have taken profit. Today you would have made some, say, let us say 100 into 200 rupees to 225 rupees or profit you would have made. And then it has suddenly come down. So 17,800 today morning, if you had done the same thing, probably the call now has become 31 rupees, 32 rupees. Probably in the morning it would have been 100 rupees or so. So you would have lost some 68 into 2, 136 rupees. And probably you would have gained, in the morning you would have gained some very decent amount of money there. Okay. So by doing this, you would not have lost anything, because the morning the 17,600 call, when it went to 17,800, should have been something like 225, 230 rupees. So you would have got 200 rupees profit there, and then you would have rolled over the 17,800 into 100 rupees, 100 rupees, 200 rupees you would have paid. Now, even if its market is going to come down, okay, completely from this, you have already made a money, right? So you have already made a futures, you have already made a profit. You have already made a profit which is 200 rupees. Now that is the money that you have now put in there. Now, if it is going to come down completely drastically, in the case of futures, you are going to make a loss. Okay, but whereas in the case of the option, there you will not make a loss, because whatever profit, with that only you have now rolled over into a new option strike. You got 200 rupees profit in the morning, and with that 200 rupees you have made a 200 rupees investment. You have removed your past investment by making some 200 rupees profit, and they have invested 200, because yesterday what you bought at 100 rupees in one single contract would have become 130 or so, 100 rupees would have become 230 or so. So in two options you would have made something like 250 or 260 rupees. Now 17,800 you will be investing now 200 rupees, right? So 50-60 rupees is the difference where you will still keep the money with you. Okay, so you will not have you will not lose. So you keep that money with you and see whether you are going to make further gains from here. Now alternately 17,800, if you have invested 100 rupees in the morning, it has become 32 rupees right now. So 68 into 136 rupees is what you have lost. Morning you would have gained from 230 rupees or so, 136 rupees or loss. Now what you do is that 100 rupees still you may have a money. So what you do is now you go for a fresh investment 17,600 for 101. Okay. Now that means right now it looks at this moment it will look that for only you have only invested another 100 rupees or so. So from here it will look to be a tremendous gain. So I hope we are able to get the point, which we will again explain to you next week. So today morning, let us say 17,800, you invested 100 rupees. After taking a profit, which is yesterday you invested 100 rupees or so, and today it has become 200 or so, the same thing. So 2 units, 100 into 2, 200 you would have made the money, and today you invested the same year. Okay. Now this has become 32. This has become 32. So 68 into 2. This position will be losing 136 rupees right now. But in the bond, you already got 200, 136 rupees. So you got 64 rupees till the profit. Now what you are doing is, you are now removing this position. You are removing this position and buying afresh. Buy 2 contracts of 17,600. So you will be paying 200 rupees right now. 64 rupees is what you have already gained. 136 rupees is what. So it is just enough that if the market just rallies by another 60-65 rupees from here, from 17,600 levels. So then in that case, from that point you will start gaining considerably, because if it goes to 17,800, in futures you would have made only 200 rupees, but whereas you will make more money here. So the rolling over of options is something which you have to consider. You buy a call, if it is at the money also, in order to prevent a time decay, you just keep rolling over the position at every 100 rupees level also, at 100 every rupees level also. In order to avoid a little bit of time decay, what I suggest is that instead of going for nearest week, you do it for another week, which is probably the next week, or probably for the next month end also. So let us look at this concept again on Monday. Thank you very much. So if you have any doubts right now, please ask. Thank you. Okay, we will arrange for a Tamil language video. What is margin sell Nifty option? No, what I am saying is, what is margin sell Nifty option? See, any Nifty option if you sell plain, it will attract something like a futures. Maybe there is some difference, but it will attract something like a, so I am not talking about any sell side. I am only talking about a buy side or a buy spread side. Okay, buy call spread. Okay. Now, so this is it. So probably if you have any other specific questions, you may ask now. So we will discuss the rolling over of the options on Monday. Please attend that. Okay. Thank you very much. Thank you very much. Stay safe. Happy weekend. Thank you. Bye.